Okay, let's just dive right into this explainer. Because if you're stepping up to the market with, gambling fantasies, we need to completely reset your mindset right now. It's time to pivot to professional, routine-based execution. Today, we're breaking down the hard truths, the technical pillars, and the absolutely rigorous discipline you need to actually pull money out of intraday trading. We're kicking things off with this classic Bollywood quote from our source material. The heart has hopes, the eyes dreams, and there is money in the bank, so what's holding you back? It honestly perfectly captures those dangerous, romanticized fantasies that so many novice traders bring to D Street. They step in expecting instant millions just because they've got some capital and a gut feeling. They assume picking the right stock is just this one-way ticket to daily supernormal profits. But as we're going to see, the market is a brutal enforcer of reality. So here is our roadmap for today. We'll start with the novice's reality check, move on to mastering moving averages, navigating with floor pivots, combining those tools for confluence, and finally, managing risk. Section 1. The novice's reality check. Every truly successful trader has to survive these 3 stages. It almost always starts with the wow stage. You're greed-struck watching literally millions float across the screen, thinking it's going to be easy. But then comes the inevitable, painful stage of self-discovery. And actually, only after surviving that crucible do you finally reach professional execution, armed with the actual methodology and emotional control we're about to build. So here's the absolute kicker. You have to accept that even with the best systems and the most incredible analysis, you only have a 60% probability of success on any given trade. Yep, 60%. That's just the math of the market. The reason so many people fail is they're desperately searching for total certainty in a fundamentally uncertain environment. Once you accept this 60% reality, you instantly see why risk management is non-negotiable. You literally stop trying to be right all the time and you start focusing on how to manage your capital when you are inevitably wrong. Moving on to Section 2. Mastering moving averages. If you want to stop guessing, the 10, 20, and 50 moving averages are basically your best friends. They cut through all that random, chaotic price noise to show you the actual trend. Markets, as you know, do not move in straight lines. An uptrend has down days, and a downtrend has up days. The moving average just smooths the whole thing out. When the price stays above that upward sloping line, you're in an uptrend. Falls below, momentum's shifting. It really is that simple. Now, you are going to build your entire daily routine around the 20 MA. Think of this as your baseline. You're looking for entries when the price rises above it or when the price pulls back to the 20 MA and uses it like a trampoline for support. On the flip side, if the price falls below the 20 MA and that line caps any rise, well, you start looking for short entries. The 20 MA basically tells you exactly who is in control of the day. All right, Section 3, navigating with floor pivots. Placed right on your chart every morning, these pivots act as a sort of self-fulfilling prophecy. Because they're mathematically derived from yesterday's data, literally millions of market participants are watching these exact same levels. They act as neutral battlegrounds where bullish and bearish sentiments just collide head-on. Take a look at the central pivot range, or CPR, sitting right there in the middle. It's surrounded by these distinct layers of support and resistance. Trading activity above this central equilibrium, generally bullish, aiming for R1, R2, and R3. Activity below, bearish, heading toward S1, S2, and S3. Listen, these are not just arbitrary lines drawn on a screen. These are your definitive navigational milestones for the day. Let's jump to Section 4, combining tools for confluence. Confluence is, well, it's the absolute magic of the market. It's that explosive synergy created when your moving averages, your floor pivots, and your broader market context all align perfectly to validate a really powerful entry. You aren't just looking at one single indicator in isolation anymore. That's a rookie move. Instead, you're putting together an entire orchestra to create a symphony of confirmation. Once you spot that beautifully aligned trend through confluence, here are the 4 specific tactics you'll use to safely execute your trade. Correction, pullback, consolidation, and rejection. Having these clearly defined tactics prevents you from jumping blindly into random emotional trades. So ask yourself, how do you actually know when it's time to go full throttle? What creates that undeniable heavyweight Muhammad Ali knockout punch in the market? You get that Muhammad Ali punch when fundamental news, higher time-frame moving averages, and intraday pivots all perfectly converge. Just imagine a stock getting incredibly positive sector news, opening above yesterday's high and bouncing perfectly off the central pivot range while being supported by a rising 20 MA. Wow. When you get a synergy of factors like that, that's when you can expect amplified, rocketing moves. It's a total game changer. But hold on, you never ever jump in blindly. Notice the long downward tails on the candles right at these key levels? That indicates the market has tested a zone and strongly rejected it. This confirms the market is actually honoring your strategy. You enter after this confirmation, ensuring your confluence zone is holding up under live active market fire. Finally, Section 5, Managing Risk. Look, to survive out here, you have to completely drop your ego. You absolutely must abandon the desperate need to be right and ruthlessly cut your losses when the charts turn against you. Technicals don't lie. People, balance sheets, opinions, they can all be camouflaged, but price action is truth. If the trade fails your thesis, please don't just sit there glaring at the screen. Cut the loss, clear your mind, and go find another opportunity. Conversely, when you do catch a winning trend, you'll use the 8 MA line as a trailing stop so you don't exit prematurely and just leave money on the table. The 8 MA does a fantastic job of keeping you in an aggressive, dynamic move. As long as the price continues to close above the 8 MA in an uptrend, just let it ride. We aren't here doing charity work, right? Use the 8 MA to extract maximum value from a favorable market. And remember this. Recovering money from a losing position is honestly 10 times more difficult than making it in the first place. If you lose your capital, your ability to trade the next perfect setup is totally crippled. Never, ever average down on a bad trade hoping for a magical reversal. Doing that is just a total ignorance of the laws of probability. Your capital must be fiercely, aggressively protected at all times. So by embracing that 60% probability math and rigorously following this confluence routine, you are finally ready to approach the market like a true professional. The tools are right there in your hands. So ask yourself tomorrow morning at the opening bell, are you going to trade based on a gambling thrill, or are you going to execute with cold, calculated discipline? See you on the next explainer.